Most people think Klarna is being generous. You buy something, split the payment into 4 chunks, and pay 0 interest. Sounds like free money, right? But here's the thing. Klarna isn't a charity. It's a billion-dollar fintech company. So if you're not paying interest, who is? In today's video, we're following the money to see how Klarna actually makes billions without charging you a penny in interest. Once you understand Klarna's business model, you'll see why every store wants you to use it, and why that interest-free offer isn't quite as free as it seems. This is the Finance Files of Klarna. Before we follow the money, we need to understand what Klarna actually does. At its core, Klarna is a buy now, pay later service. You buy something online. Klarna pays the merchant in full immediately, and then you pay Klarna back in installments, usually 4 payments over 6 weeks. Klarna has tens of millions of active users worldwide and processes billions in transactions each year. In recent years, Klarna generated roughly 2.2 billion euros in annual revenue, which is around $2.4 billion at recent exchange rates. So here's the question. If you're paying 0 interest on those installments, where is that money actually coming from? Klarna makes money from 3 main sources, and the biggest one isn't you. It's the store you're buying from. The majority of Klarna's revenue comes from merchant fees, which are charges paid by retailers on every Klarna-powered purchase. Every time you use Klarna to buy something, the retailer pays Klarna a fee. That fee typically sits in the low single digits to mid-single digits as a percentage of the purchase price, depending on the deal Klarna has with the merchant. So if you buy a $100 pair of trainers using Klarna, the store effectively gives up a few dollars of that sale just for letting you split the payment. The second revenue stream is late fees and interest on long-term financing. A smaller but still meaningful portion of Klarna's income comes from charging consumers directly. The opposite of what it does on those interest-free, pay-in-4 plans everyone's so fond of. Klarna offers longer-term financing options where you pay over many months. Those plans do charge interest, often at rates more like a traditional credit product, depending on your credit profile and the market. And if you miss a payment on any Klarna plan, you can be hit with a late fee. This is usually a relatively small fixed amount per missed payment, which adds up when enough people slip behind. And finally, there's a third, smaller stream: ads, data, and card services. Many of you may not know this, but Klarna runs its own shopping app where it promotes products and earns affiliate commissions or advertising fees from brands that want visibility inside that ecosystem. It also offers a physical Klarna card in some markets, along with subscription-style services and business-to-business payment tools, all of which add smaller but growing revenue streams on top. Now let's break down exactly how the money moves, because this is where most people get it wrong. Step 1, you're on a website, you add something to your cart, and at checkout, you select Pay with Klarna. Step 2, Klarna immediately pays the merchant the full amount, let's say $100. The merchant gets their money right away, minus Klarna's fee. Step 3, you pay Klarna back in 4 installments over a relatively short amount of time. 6 weeks, for example. 4 payments, 0 interest. From your perspective, it feels free. From the merchant's perspective, they paid for the privilege of closing the sale, and Klarna takes a fee for taking on the credit risk. Because if you don't pay back Klarna, there's no way to reclaim that money from the merchant. The sale is done. That means Klarna's whole model depends on a simple mix. Most people paying on time, a smaller group paying late and generating fees, and only a relatively small slice defaulting completely. When too many people stop paying, those unpaid balances quickly become one of Klarna's biggest costs, and it can eat into a lot of money it earns from merchant fees and financing. So the business only really works when the fees coming in from merchants and late payers comfortably stay ahead of what Klarna loses to defaults and the cost of running the operation. So given the merchants are already paying 2% to 3.5% in fees every time you use a credit card, and then Klarna walks in and charges them another few percent on top, why do retailers keep saying yes? Because the math still works in their favor. Klarna doesn't just process payments, it changes buyer behavior. Buy now, pay later options like Klarna have been shown to increase conversion rates by 30 to 50%. More people complete their purchase instead of abandoning their cart. Splitting a $200 purchase into 4 $50 payments feels more manageable, even though the total cost is exactly the same. The psychological shift is what merchants are paying for. On top of that, average order value tends to rise. People spend 20 to 40% more per transaction when they can spread payments out. So even though the merchant is paying Klarna on each transaction, the extra sales and higher basket sizes often more than cover the cost. And let's not forget there's competitive pressure. If one retailer offers Klarna and a similar retailer doesn't, the Klarna store becomes the easier impulse buy. In a world where buy now, pay later is everything, not offering it can mean losing the sale. On the surface, it looks like a neat wish for everyone. You get flexibility, merchants get some sales, and Klarna gets its fee. But the way this model works also creates pressure points, especially for consumers. First, the stacking effect. Klarna makes individual purchases feel smaller and more manageable, which can nudge you into saying yes more often, especially on things you might normally wait on. If you use Klarna multiple times, those small payments start to overlap. 4 payments here, 3 payments there, all landing on different days of the month. And suddenly your future bank balance is carrying a lot more commitments than you realize. That makes it much easier to feel stretched, slip behind, or simply forget a payment, turning what felt like harmless installments into a real risk of falling into arrears. Second is the late fees. Miss an installment and you can be charged a fixed penalty. One fee on its own might not seem dramatic, but across multiple purchases and millions of users, those penalties become a meaningful part of the business. Third, your credit track record. While the lighter touch pay in 4 style plans often avoid hard credit checks, missed or seriously overdue payments can still end up reported to credit agencies in some regions, hurting your score and making other borrowing more expensive later. So what should you take away from all of this if you're using Klarna at checkout? First, interest-free is accurate on the surface, but the cost is sitting somewhere else in the system. Merchants are paying fees, and over time, that kind of cost tends to get priced into what you pay for products. So even though it feels interest-free today, you're likely covering it the next time you shop. Second, Klarna shouldn't feel like extra money. It's just a different timing on the same bill. If you couldn't completely afford the purchase in one go, spreading it out doesn't magically make it cheap. It just makes it feel easier in the moment. Third, track your commitments. If you're using Klarna on multiple purchases, treat those installments like any other bill. When payments are scattered throughout the month, it's very easy to lose track. And that's when missed payments, fees, and credit problems start to creep in. And finally, remember what Klarna is optimized for. Klarna is designed to reduce friction and make yes the easy option. If you use it deliberately, that flexibility can genuinely help with cash flow. But if you're using it without thinking, it mainly helps you spend more, pushing you closer to a missed payment, mounting fees, and long-term damage to your finances, all while filling the pockets of merchants and Klarna. In the end, Klarna isn't making its money by charging you headline interest on every plan. It's making its money by charging stores for higher conversion and bigger baskets. And at the edges, from late fees and financing. If you understand who's paying what and why, you can decide whether splitting that payment is helping your budget or just helping you spend more.